Welcome to the Deep Dive. We're here to cut through the noise and really get to the core of topics that can feel, well, pretty complex sometimes. You're already tuned into the markets, so today we're taking things up a notch.
Right.
We're diving into that sophisticated world of financial derivatives, specifically futures and options. We'll be using the Futures and Options Blueprint from Zebra Learn as our guide.
Yeah, it's a good framework.
And our mission isn't just definitions. It's about uncovering the strategy, the risks you might not immediately see, and what it all really means so you come away truly informed.
Exactly. For an audience like yours, already familiar with the basics, this is about adding that extra dimension. We're moving past the what's and digging into the why it matters for anyone in the market.
Okay.
The goal is nuanced insights, understanding how they work, sure, but also their strategic power, the leverage, and those risks that sometimes get glossed over, hopefully sparking some haha moments for you.
Okay, so let's unpack this a bit differently then. We know a derivative gets its value from an underlying asset. That's the textbook definition. But for someone active, someone who follows this stuff, what's a common misunderstanding or maybe an implication people overlook about that basic fact?
That's a great question. I think what's fascinating is how that derivation allows for incredible capital efficiency and flexibility in managing exposure.
Right.
But it also means these things rarely have intrinsic value on their own. Their price is just a reflection, sometimes a really amplified reflection of what the underlying market is doing.
Okay.
The blueprint nicely lays out the 6 core classes of underlying assets: stocks, bonds, currency, commodities, interest rates, and indices.
So a wide range.
Huge range. Everything from, Reliance shares or TCS to the Nifty Y50 index, USD INR currency pairs, even commodities like sugarcane or steel.
Right.
For today, though, we'll probably focus mostly on stocks, currencies, commodities, and indices. That's where a lot of the action in derivatives trading happens.
Makes sense, especially given the volatility you see in those markets. So we get the concept. But for established players, why derivatives at all? Why not just, buy or sell the actual stock or commodity?
Why the extra layer?
Exactly. It often comes down to this choice between spot trading, immediate exchange, and something more strategic, forward trading.
Right. Spot trading is simple. Pay cash, get the goods, done today. Like a baker buying sugar right now at the market price because they need it immediately.
But maybe they're worried about prices going up next month.
Precisely. And that's where time introduces uncertainty. Forward trading was developed to manage that exact problem. It's basically a custom agreement between two parties, a buyer and a seller, to trade an asset at a price they agree on today, but for delivery on a future date.
Oh.
So think about a big food company worried about cooking oil prices rising. They could make a deal, a forward contract, with a supplier now to lock in a price for a huge shipment 6 months down the line.
So it's like a private insurance policy against price swings.
Yeah.
Gives both sides some predictability.
Exactly. But there's a catch with these forwards being so custom, right?
What's the downside?
Well, that customization means they're over-the-counter OTC. They aren't traded on a public exchange.
Okay, so private deals.
Yeah. And that leads directly to the big challenge: counterparty default risk.
Meaning the other side might not follow through.
Exactly. What if that oil supplier hits financial trouble in 6 months? They might just default, leave the food company scrambling to buy oil at potentially much higher market prices.
And getting your money back is tough.
Very. Going through legal channels is slow, expensive. It's a major drawback, especially when you think about bigger risks across the whole system.
Okay, so here's where it gets really interesting. Because that counterparty risk in forwards, that problem, was basically the trigger for a huge innovation. The development of futures contracts. Futures are like the standardized exchange-traded upgrade from forwards.
Absolutely. It wasn't just a small change. It was a total rethink of how these markets work. The blueprint highlights the key differences, and they're significant.
Like what?
Well, first, unlike those custom forwards, futures are standardized. Every contract for, say, Nifty Y futures has the exact same quantity, quality specs, and expiry date.
Okay, so they're interchangeable.
Precisely. And that standardization is what allows them to be exchange traded. They trade on regulated platforms, think NSE, BSE here in India. That brings transparency, liquidity.
And it solves that big risk problem we just talked about.
Yeah.
Counterparty risk.
Yes, fundamentally. The exchange itself becomes the middleman, the central counterparty.
How does that work?
When you buy a futures contract, you're effectively buying from the exchange. When you sell to the exchange. It guarantees the trade on both sides.
Ah, okay.
So it removes the counterparty default risk between individual traders, makes the whole system much safer.
Plus, they're regulated.
Rigorously. By bodies like SEBI. That builds confidence, ensures fair play. Another huge difference is settlement. Forwards might involve actual delivery, but futures, especially for financial assets like stocks or indices, are almost always cash settled. You just pay or receive the difference in price. No physical goods change hands.
And that daily mark-to-market thing, that's crucial too, right? Settling up gains and losses every single day.
Oh, absolutely. Game changer for risk management.
Oh, so?
Because profits and losses don't just pile up until the end. Capital moves between the winners and losers daily.
Okay.
This stops huge, unmanageable losses building up silently, which could cause defaults. But it also means traders need to manage their cash flow daily. You might get a margin call demanding more funds, even if you think your trade will work out eventually.
Right. But it also means you can get out easily.
Exactly. Positions can be squared off, meaning you exit by making the opposite trade literally any time before the expiry date. Huge flexibility compared to getting stuck in a forward contract.
Okay, let's quickly touch on some key terms for futures, just to make sure we're all on the same page. There's initial margin.
Yep, that's the deposit you put down to open the trade, like collateral.
And maintenance margin. How's that different?
So the initial margin gets you in. The maintenance margin is the minimum level your account balance needs to stay above. If losses eat into your margin and it drops below that maintenance level,
Oh.
yeah, you get a margin call. The exchange demands you top up your account immediately. If you can't or don't, they can force close your position to limit further losses.
It's the system protecting itself.
Exactly. Keeps the whole mark-to-market process working. Then you have the expiry date, obviously the last day the contract is valid, usually the last Thursday of the month for stock futures in India.
And simple ones. Long if you think the price goes up.
Right. You're buying.
Short if you think it goes down.
You're selling first,
Yeah.
hoping to buy back cheaper later.
Now, this is interesting. The difference between the spot price, the price right now, and the futures price, they aren't always the same. We hear terms like contango and backwardation. What do those tell us?
Yeah, this gets into market expectations. Contango is when the futures price is higher than the current spot price.
Okay. Why would that happen?
Usually it suggests the market expects prices to rise between now and expiry, or it could just reflect the cost of carry, things like storage costs for commodities, interest costs, insurance.
And the opposite.
That's backwardation. Futures price is lower than the spot price, often signals that the market expects prices to fall. Or sometimes it can mean there's a current shortage of the asset, so people are willing to pay a premium for immediate delivery right now.
Fascinating.
But crucially, whatever the difference is during the contract's life, the futures price and the spot price must converge at maturity. On the last day, the future becomes the present.
So those price differences are like little windows into market sentiment. Ultimately, then, these derivatives, they're tools for managing risk, for speculating on where prices are headed, and crucially, for getting more bang for your buck through leverage.
Precisely. Those are the core functions.
Okay, let's shift gears slightly. We've talked futures, the obligation. What about options? How do they fit in? They seem to offer more flexibility.
That's the key word, flexibility. Options introduce the concept of a right, but crucially, not a compulsory obligation.
Right, not obligation. Big difference.
Huge. It creates a completely different risk and reward structure. There are two main types.
Go on.
A call option gives the buyer the right, again, not the obligation to buy the underlying asset at a specific fixed price. We call that the strike price.
So you'd buy a call if you're bullish,
Yeah.
expecting the price to go up.
Exactly. If the price goes way up, you exercise your right to buy cheap. If it goes down, you just let the option expire. You're not forced to buy.
And the other type.
A put option. It gives the buyer the right to sell the underlying asset at that fixed strike price.
So you buy a put if you're bearish, expecting the price to fall.
Yep. If the price tanks, you exercise your right to sell at the higher locked-in strike price. If the price goes up instead, again, you just let the option expire worthless. Your loss is limited.
Limited to what you paid for the option itself.
Exactly. That payment is called the premium. It's the cost of buying that right or that flexibility.
And how is that premium decided? It's not random, obviously.
No, definitely not. It's complex. It includes any intrinsic value. Like, if a call option's strike price is already below the current market price, it's in the money.
Okay.
But a big chunk is time value. Options are wasting assets. As the expiry date gets closer, the time value shrinks. That's time decay.
Ah, fated decay.
Right. And maybe the biggest factor is implied volatility, how much the market expects the underlying asset's price to swing around in the future. Higher expected volatility means a higher premium.
Makes sense. More chance of a big move makes the right more valuable.
Exactly. Then you have other details like lot size, how many units one contract covers, the bid-ask spread, the difference between buying and selling prices, and open interest, how many contracts are currently active. You'll see quotes like Nifty 17,500 SEP 2021 CE equals 0, 150 unit.
Breaking that down, Nifty is the underlying.
Right.
17,500 is the strike. SEP 2021 is expiry. CE means call option.
PE would be put equivalent.
And 150 is the premium per unit in the lot.
Got it. Yeah.
That's clear for the buyer. Limited risk, potential for big gains. But what about the person selling that option? Their risk seems way different.
Oh, completely inverted.
Right. Selling a call option, for instance. Your maximum profit is just the premium you received. But if the stock price shoots to the moon, your loss could be, well, unlimited.
Theoretically, yes.
Well, why would anyone do that? Why take on that kind of risk?
It raises an important question. It's a calculated bet. The seller collects the premium up front. Their bet is often that the underlying price won't make a huge move against them.
They're betting on stability or time decay.
Exactly. They might believe the price will stay flat, move sideways, or even move slightly in their favor. If the option expires worthless, out of the money, they keep the entire premium as profit. It's a strategy based on probabilities, collecting income, often requiring sophisticated risk management to handle potential adverse moves.
Okay, so it's not just gambling. It's a strategic play on probability and volatility. Fascinating. So whether you're buying or selling, options are complex bets. Who are the main players actually using these instruments, futures and options, in the real world? We talk about categories, but I guess the lines blur.
They definitely do, but generally we think of three main groups. First, hedgers.
The risk managers.
Primarily, yes. Their main goal is risk reduction, using derivatives like an insurance policy. A farmer locks in a selling price for wheat, an airline hedges against rising fuel costs. They might give up some potential profit for the sake of certainty.
Okay.
Speculators. These are the participants actively taking on risk, betting on market direction. Their primary motive is profit. They often use leverage to amplify potential returns.
Which also amplifies potential losses.
Absolutely. High risk, potentially high reward.
And the third group, arbitrageurs. They sound almost mythical.
They're kind of like the market's efficiency enforcers. Their goal is to exploit tiny, temporary price differences for the same asset in different markets.
Like buying tomatoes cheap in one market and immediately selling them slightly higher in another.
Exactly that principle. Buy low, sell high, simultaneously, theoretically locking in a risk-free profit. Now, pure risk-free arbitrage is rare in today's fast electronic markets.
The gaps close too quickly.
Very quickly. But their activity is vital. It forces prices into alignment across different exchanges or related instruments, making the whole market more efficient.
So it's crucial to really see the difference between hedging and speculation. One is about safety, reducing risk, maybe lowering your max profit because you're paying for that safety net.
Insurance costs money.
Right. And speculation is the opposite, embracing risk, aiming for maximum profit, but knowing you could face significant losses. Two very different mindsets using the same tools.
Totally different objectives.
Okay, we've looked at both forwards and futures. Let's just crystallize the key differences one more time, because it really highlights why futures became so dominant.
Good idea. It really comes down to solving the problems inherent in forwards.
So number one, standardization. Forwards are custom, one-off deals.
Right. Futures are completely standardized. Same terms for everyone trading that contract.
Two, regulation and trading. Forwards are private, OTC, unregulated.
Futures are traded on regulated exchanges, overseen by bodies like SEBI, much more transparent and secure.
Three, exiting the position. Getting out of a forward contract early can be difficult or impossible.
Whereas futures are highly liquid. You can square off your position easily anytime before expiry.
Four, counterparty risk. The big one. High risk in forwards because you're relying on that specific counterparty.
Virtually eliminated in futures because the exchange acts as the counterparty to every trade.
Five, settlement. Forwards can involve physical delivery.
Futures, especially financial ones, are overwhelmingly cash settled, much simpler.
And finally, mark-to-market. Profits and losses build up until the end in forwards.
Futures settle gains and losses daily. Better risk control, but requires daily cash management.
Those differences aren't just technicalities. They fundamentally change the safety, the accessibility, and the liquidity of the market. Futures created a much more robust system.
No question. It democratized access and improved integrity significantly.
Right. We have covered a lot of ground today. We've gone way past just defining derivatives, looking at why they exist, from hedging risk to speculating for profit. We've contrasted forwards and futures, options, really dug into the mechanics and the strategy. So hopefully you now have a much deeper feel for these powerful instruments.
Yeah, and connecting it to the bigger picture, it's so important to remember that double-edged sword. Derivatives offer amazing strategic tools, yes, for hedging, for efficient exposure, for potential profit, but the leverage involved means the risks are amplified too. That warning from the source, possibility of incurring losses initial capital, that's not an exaggeration with leveraged instruments like futures.
It really underscores the need for understanding.
Absolutely. Sophisticated understanding of the market, position sizing, risk management. It's not optional if you're actively involved.
So what does this all mean for you listening?
Well, this deeper knowledge is genuinely powerful. It lets you look at market news, at company reports, even at global economic trends with a much more critical, informed eye. You can start to understand the why behind certain corporate strategies or market movements. Whether you ever trade these yourself or not, knowing how they work and who uses them is invaluable for just navigating the financial world intelligently.
Yeah, it informs your perspective. Definitely. So here's a thought to leave you with. Think about the subtle ways derivatives, even just the basic concepts, might influence things you encounter every day. Maybe the price stability or instability of commodities that end up in your shopping basket. Or the complex ways banks and institutions manage risk, underpinning the financial system. How might understanding these contracts, futures, options, and how they're used strategically change the way you read the financial headlines or think about the economy around you?
It's definitely something to chew on.
It is. Thank you so much for joining us on this deep dive. We hope it's shed some light on the intricate but really fascinating world of futures and options and maybe spark some further curiosity for you.